Today I look at the effect the time of day can have on price action, how this can affect trading strategies, and how you can turn it to your advantage. Back after this brief message. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. If you're a talented trader looking to attract investor capital to your strategies, Darwinex is the fastest way for you to do this. We enable traders to raise third-party investor capital and then charge success fees on high watermark profits. Additionally, Darwinex itself invests in its traders with our seed capital allocation program that allocates up to €90 million per year in successful trading strategies. So, if all of that sounds interesting, learn more by clicking on the link here, or you can find further links in the description right below. Now back to today's tutorial. The time of day is a significant contributing factor to how price action behaves. Ignoring this can therefore have an equally dramatic effect on the performance of trading strategies. Today I show how this can be turned to our advantage for the stochastic RSI trading strategy that we've been studying. Let's take a closer look. This is now episode 29 of the Spotlight on Indicators series. To get access to all previous episodes, you can find a link in the video description. So far, we've done an in-depth indicator research on the standard RSI indicator and also the stochastic RSI. We implemented a very simple strategy that we could backtest, and last time started to perform a systematic analysis on nothing more than entry and exit signals produced by each of these indicators. Today I take this a step further and start to look at filters, and specifically looking at how the time of day can affect the market regime, which in turn can affect the performance of a trading strategy. So, why does the time of day matter so much? Well, quite simply, markets behave in different ways at different times of the day. In particular, there are certain key times of the day when new sessions open, and here there's increased volume, and this also often causes increased volatility in the price action. But probably more importantly, these key points of the session open times are very often the point at which the dynamics of price action changes. And so what's happened in one session, such as the Asian session, might be completely different to what happens in the European session that follows. So for example, in the Asian session, this may have taken the pound-yen much higher as part of an intraday trend, but then as soon as the European market opens, we might very often see that price reverse and sometimes even finish where it began the Asian session. What's more, the market regime can change. And what I mean here is that in one session we might see strong trending behaviour, whilst in the next that seems to stop almost instantly and the market begins to enter a trading range. Now, the important point here is that these changes in the market dynamic can significantly affect the performance of trading strategies. So let's first look at a chart and see how these changes from one session to another manifest themselves in the price action. So we're looking here at a 15-minute chart of the dollar CAD across a 3-day period. Underneath the price action, I've got the volume shown so that I can explain how this changes as those new sessions start. So first of all, in the Asian session, we see a relatively strong downtrend, as you can see here. And then if you look at this peak in the volume right here, this is the exact moment that the European markets open. And look what happens to the price action. Instantly it reverses and goes the opposite direction to that the Asian session took it. Then, if we look at this spike in the volume right here, this is when the US market opens. And as you can see, this is accompanied by a big increase in volatility. And initially, prices fall rapidly against what happened in the European session, but then recover, take it to a high above where the Asian session started, and then the market enters this highly volatile trading range. Let's take a look at the next day. So here, after some initial increase in price, the Asian market then takes the price lower strongly again. And if you look at this peak right here in the volume, this is when the European session opens, and then the price enters more of a trading range here without the price really going anywhere. But then, as the US session opens and we get this spike in volume here, everything changes again. Instantly, the US market opens and price shoots up. And it continues to go up until the end of that US session, where prices then begin to stagnate. Let's take a look at the next day. Again, we have the Asian session on the left-hand side here. And look at the point that the price direction changes. It's exactly at the European Open right here. And pretty much as soon as the European market opens, prices take on different behaviour and start to trend up significantly. Then it's the first spike in volume here that signifies the start of the US session, and again almost instantly price reverses once again and comes down. And so we can clearly see here the impact of those new sessions opening and the huge effect that has on price action. Now, of course, it doesn't always happen in such a dramatic way as this. And I've obviously chosen these 3 days because they illustrate the point well. But I'd encourage you to look at charts and to add the volume indicator on and take a look at the impact of these session opens. And you will see this behaviour time after time after time. So to just ignore this behaviour means that we're leaving a lot to chance in our trading strategies. Now, let's return to the equity curves that we saw in the previous episode. So, as a quick reminder, the yellow curve here is the strategy based on the stochastic RSI using levels of 90 and 10, and the red equity curve is for the standard RSI using levels of 70 and 30. And as well as the stochastic RSI looking as though it's more effective at the implementation of an overbought oversold strategy, another major difference was the number of trades that were generated. So the stochastic RSI system generated almost 4 times as many trades. And I commented that this is something that will help us significantly as we go through this process, because it will help to ensure a higher statistical significance. Whereas with the standard RSI, as we begin to add filters, we may well start to encounter issues of low sample sizes and therefore lose confidence in the results that we're achieving. So let me show you the effect here that a time of day filter can have on a strategy. So I'm going to stick with the yellow stochastic RSI equity curve here. So we'll display that on its own. And now I'm going to overlay the new equity curve once we have implemented a time of day filter. And as you can see, performance is improved significantly. Take a look at some of the larger drawdowns in the yellow equity curve and then compare those to the drawdowns that we see with the red equity curve with the time of day filter. Also, look at some of the periods of time when the yellow equity curve performed well and rose and compare that to the red equity curve. And what we see is that on both of those counts, there is an improvement. So I haven't spoken about any details of how I've gone about the implementation of this filter, but that will be the topic of the next episode. And I'll show you that for the stochastic RSI strategy, And then in episode 31, I'll do exactly the same for the standard RSI strategy, so that we can once again compare results. Before you go, would you like to find out more about how Darwinex helps thousands of traders just like you to attract investor capital? If so, either click on the Darwinex logo on the screen or find other links in the video description below. Now, until next time, trade safe.